Let's move to the second indicator that will be our helping hand in making money. And it is called a stochastic. Let's remove the MACD for the time being and add stochastic. Type in stochastic and we need just stochastic. And here it is. And once again, just like with the MACD, you can adjust the settings, and those I will, the custom settings I will give you a little bit later. And depending on your platform, you can add, you can change the general look of the stochastic, meaning the colors, lines, shapes, and so on and so forth. And I do use quite different look to the stochastic, which I'll show you later on. But for the time being, I do like to remove these color zones as well from stochastic. I just like to see the line so that I'm not distracted by any color zones in the middle. And I do remove the broken line, the orange one, which is the stochastic D. I do remove it. I like seeing just the line, nothing else. And later I'll show you how to add a few color zones that I have in my platform when I trade, which in my opinion makes it a lot easier to look at stochastic. A few things that I would like you to add right away to your stochastic are a few horizontal lines. We have two horizontal lines already, and those are the 20 and the 80. These are here, the 80 and the 20. The stochastic values are from 0 to 100. Unlike with MACD, MACD has infinite numbers and it keeps floating in between them, and there is no range, so to speak. But stochastic is a completely different indicator, which is being calculated completely in a different with a different calculation and with a different method. The data that it produces is within 0 to 100 range. So the value is from 0 to 100. And the important values are 80, 20, and let's add a few more. And those are the 50, so the middle, the so-called the zero line, the neutral area. So let's add the 50. Let's add the 60. And let's add the 40. And these are the lines that I like seeing in my stochastic. So the 80, 60, 50, 40, and 20. The 80 symbolizes the area that we are looking for when we are trading, and so is the 20. So anything above 80 and below 20 are the so-called power zones, but I'll explain them to you a little bit later. Now for the zone which is from 60 to 40, this is so-called the neutral zone. And this zone is also quite important. And we must be able to see with the naked eye that the stochastic is in the neutral zone. So having these lines here are a visual benefit. So 80, 60, 50, 40, and 20 will be the lines that we are going to be using a lot. Hang in there and let's talk about stochastic in a very technical terms. So it is a momentum indicator comparing a particular closing price of a certain product to a range of its prices over a certain period of time. The sensitivity of this indicator to the market movements is reducible by adjusting the time period or by taking a moving average of the result. So it is used to generate overbought or oversold trading signals, utilizing a 0 to 100 bounded range of values. Hang in there, we are almost finished. Almost. So the general theory serving as the foundation of this indicator is that in a market trending upwards, prices will close near the high, and in the market trending downwards, prices close near the low. Transaction signals are created when the K crosses through a 3-period moving average, which is called the D. And the K we have removed, the D we have removed and the K is still here. So right away you can see that we are going to be using the stochastic just like with the MACD, not in the way that it was intended to be used. But for the time being, let's continue with this nerdy stuff. So what does the stochastic indicator tell you? The stochastic oscillator is range bound, meaning it's always between 0 and 100. So this 100 is here and 0 is down here. This makes it a useful indicator for overbought and oversold conditions. Traditionally, readings over 80, and this is the line right here, the 80 line. The readings over 80 are considered in the overbought range. So right here, when the stochastic is above 80, that means that the market is overbought and we can expect it to move down. In theory, this is just theory on stochastic. Later, I will be teaching you how to actually use it for making money. So on the readings under 20, this line right here, are considered oversold. However, these are not always indicative of impending reversal. Very strong trends can maintain overbought or oversold conditions for an extended period of time. Instead, traders should look to changes in the stochastic oscillator for clues about future trend shifts. So this is quite an interesting thing because it is absolutely true that a lot of times in a nice climbing trend or falling trend, the stochastic can keep staying in the overbought range and not even go lower into the neutral zone, as we can see right here. As the powerful trend up begins, we go once into the overbought zone, so which I call the above 80 zone, and then we try to go into neutral, but we are faced by more power and then again power, and this can continue on for a really long time. So the stochastic just being in the overbought zone doesn't mean that the market is about to reverse. Not at all. That is true. What we should be looking for are clues and signs of a potential reversal, just like in the MACD. So in stochastic, we can say that we have waves as well. However, this indicator is quite different from MACD and the way it calculates and the things that it shows. And for that reason, I do not call these waves. I call them peaks, stochastic peaks. So waves are in the price and in the MACD, but in stochastic, those are peaks. Peak up and a peak down. Peak up, peak down, and so on and so forth. So we need to be looking for clues for potential trend direction changes, comparing the peaks. So for example, here in this trend, we can see that there has been quite a lot of power, but then it's slowing down a little bit. And we can see that then the power returns. However, this peak right here is lower than the one before. So we need to be comparing those for us to be able to actually find clues for potential trend direction changes. So in here we can see that further we develop one more peak right here, this one. So we have 3 peaks in this uptrend already. First one, second one, third one. And as you can see, it's going lower, lower, and lower. So this is the kind of a structure, just an introduction to a structure that we could be looking for in stochastic for a potential sign of a change of direction in the price. So the stochastic oscillator charting generally consists of 2 lines, one reflecting the actual value of the oscillator for each session and one reflecting its 3-day simple moving average, because price is thought to follow momentum. Intersection of these 2 lines is considered to be a signal that a reversal may be in the works, as it indicates a large shift in momentum from day to day. Once again, this is the way that stochastic was created, and this is the logic of stochastic. But just like with the MACD, when we took a look at the examples of MACD going above or beyond the trigger, this pretty much, if you trade like that today, you will lose a lot of money very quickly. This is a completely unreliable way of trading. Same thing goes for stochastic. The stuff that I'm reading to you right now is from the older books and from the manual of stochastic when it was invented years and years ago. So as of today, I even remove completely, as you just saw, the K line, which was the broken line. I remove it completely, and this is an indicator of the fact that we are going to be using it in a completely different way. The reason why I'm telling you the basics of the stochastic is that it's for the purpose of you being familiar with what it is in general. And then we'll move to the actual way of looking at it, the way I look at it, and the way that is necessary to be making money with it. By comparing current price to the range over time, the stochastic oscillator reflects the consistency with which price closest near its recent highs or lows. A reading of 80 would indicate that the asset is on the verge of being overbought. Enough of this nerdy technical stuff of what comes out of where and all. There is even more information on stochastic that I have right here in front of me with all different calculations, but I'll just save you the trouble of listening to all of this stuff. So please, now let's talk about the important stuff that you actually need so you can resume taking notes. And here we go. So the important stuff that you can write down is that just like with the MACD, the stock settings are no good, and I will be giving you all the settings later on, and I will show you my settings in the screen for both the way the stochastic is being calculated, so all the numbers, as well as the visual settings for all the lines and the colors and all of this stuff you will have later. Now, the next important thing that you need to write down is that stochastic will be used by us to look for clues in the power of trend. So in a similar fashion to the way that we are going to be using MACD. So the stochastic will be a similar helping hand in identifying the power of the trend, the controlling the trend, and seeking out potential weaknesses of a trend, and working in general with trends. The next important thing that you can write down is that once again, there are no waves in stochastic. I call those peaks. So we will be comparing peaks and the structures of peaks, and we will see if there are any diverging peaks. So for example, if we see a divergency in MACD, we'll also be checking and seeing if there are any divergencies in stochastic. I mean, meaning the peaks in comparison to the price action. So if the two top waves in the price, one is higher than the other, we'll try and see if the stochastic is showing the same picture or there is a divergency, and how does it correlate, and how does it correlate with the MACD. And one last thing for you to write down about stochastic at this point is that we will never use it without MACD. Stochastic never produces any signals per se. We will never take any signal in stochastic. MACD is the signal giver, so we'll be looking for signals in MACD, and the stochastic will be helping us out. But in stochastic, there will be no signals. There will only be structures that we are looking for that will indicate one or another thing, but we will never use it as a reason for an entry. We will use it as a helping hand. And of course, in this combination of MACD and stochastic, MACD is by far a lot more important. Sometimes we'll see that in a trend, stochastic might be giving us some kind of a weakness, but if there is no weakness in MACD, we'll completely ignore the stochastic. This is just the rule of thumb. Stochastic is a helping hand, but nothing more than that. On the contrary, there will be trading situations where we will make our decisions purely based on MACD and completely ignoring the stochastic. And this rule is engraved in stone. Please write down with huge, vivid letters that MACD is a lot more important than stochastic. Stochastic is just a helping hand to the MACD. And MACD is the place where we will be looking for our signals, and sometimes we will be ignoring stochastic and working just with MACD in certain situations. So, and as you can see that we are slowly building up your foundation. We started with candles, then waves, trends, then I introduced some levels, and now you know about MACD, and now we've added stochastic to the mix. And this is the way I trade. I have many things that I look at that help me make good decisions at the markets. And the reason why it all works so well together is because every analytical tool and, for example, every indicator is calculated in a different way, and it is giving us completely different information. As I described before, MACD is calculated in one way and gives one type of information that has its drawbacks, of course. But stochastic is calculated in a different way and gives a completely different set of data. And of course, it still has drawbacks just like any other indicator, but those drawbacks are different to the ones of the MACD and vice versa. So in a way, the strategy that I'm working with, all different aspects and tools, they help out each other. So if one isn't not working and is sort of unclear, then the other one will pull out the situation and save the day. So this is the way how I work. I've never understood how people can work with just one thing, with one indicator, or just with levels, or just with news. This isn't for me. And this, in my opinion, if you're trading with just one tool, your trading is very limited, and it becomes quite hard to explain if you are actually successful over a period of few years. Remember that being successful in trading for 1-2 months means nothing. If you can be successful for 2, 3, 4, 5, 6, 7 years, yes, this is a good result. But few months or a few weeks, that's nothing. And the foundation for your strategy that we are building for you right now will enable you to being successful in the markets over the course of a long period of time. So you will be able to run a marathon because you will know all ins and outs of all different types of analyses and how to use them together correctly. All right, good luck on the test, enjoy your homework, and I'll see you in the next lesson.